What is amortization and how do you calculate it? I'm going to explain some of the details around this in just a moment. Okay, amortization, pretty big word. And I'm going to try to explain it in layman's terms. So when you're looking at a home mortgage, for instance, and really you can do this with any kind of lending, amortization is a calculation throughout your entire term of the loan on how your principal, which is the core amount of your payment that goes down on the main amount you owe. So you owe a certain number. Your principal is how much of your payment goes towards that main amount you owe. Next to that is going to be your interest. Now, amortization schedule, or calculating your amortization, shows how each payment may be the same, and even $1,000 a month. But that first payment typically is going to have more interest going towards your lender than principal. And every payment throughout the term, assuming it's a 30-year mortgage, would be 360 payments. So the first one's going to be heavily favored to your lender in interest and less on your principal. And as you go, those numbers start switching the other way. This is why mortgage companies don't mind if you call in and want to lower your payment by re-extending your term after you've already paid for 15 years and you want to go back to a 30, because now they're getting more favorable numbers. Lenders always get their money first. Now, on the lendingdictionary.com, we actually have an amortization schedule that you can use that's super simple, and we link to some other ones that we recommend that are very easy. I suggest you save it. Always calculate your amortization so you can figure out recoup time when you refinance and other things like that. And we have more videos on this as well.
Oh, hey guys, good to see you there. Make sure you hit the like and subscribe button. Thank you.
What I want to make sure you guys understand is when you do a mortgage, for instance, typically people that get a little more savvy look at 15 years and say, oh, the interest rate's 1/4 or 0.5% better. Let's go with that. I'll pay less interest. Now, for example, let's say you get a quote for a 15-year mortgage and the interest rate's a 3.25. Hopefully that doesn't date the video on how rates are. But let's say it's a 3.25 on the 15-year and your quote for the 30-year is a 3.5. It's a 1/4 point difference. Sounds like, okay, well, I'll save a 1/4 point if I go for the 15-year and I can afford the payment. Might as well go for it. But if you do the 30-year and you make the same payment as you would have on that 15, because they're going to give you the full numbers. If you can afford that payment, great, or close to that payment, great. In the amortization schedule, you can actually say, okay, here's the 30-year payment, and I'll take that difference. What was that 15-year payment? Oh, it's a difference of $500, $800, whatever it may be. Add that as extra payment in your amortization schedule, and it'll show you how fast you'll pay off that mortgage. And in one of the columns, it actually shows you total interest paid. And what you'll find is if you take, let's say your payment on a 15-year is $1,500 a month, and on the 30-year, it's $1,100, right? Numbers aren't exactly 50-50. Well, that extra difference, $400 a month on that 30-year, is going to actually pay more on that principal starting off, which is going to shorten the term and cut out a huge portion of the interest. Just as an example, if you were to make double up payments, so if the numbers were even, just for easy math, on a 15-year, your payment is $2,000, on the 30, your payment was $1,000. But you make a $2,000 payment on the 30-year, you're almost cutting your interest in half. So if the difference originally was 3.25 to 3.5, and you cut it in half, now you're at a 1.75, check my math, that's a huge amount of savings. So something to strongly consider. For more ways to save money on your lending, keep watching.